Welcome back to Foss & Company's Tax Credits Today podcast. I'm your host, Kevin Haley, SVP of Investments here at Foss. I've been with Foss since 2021, and I oversee all of the investor-facing conversations that we have as a firm, working closely with large corporates that pay federal tax. We work with banks, insurance companies, manufacturing companies, retailers, you name it. Our firm is one of the leaders in providing tax credit solutions to corporate taxpayers, and we're very excited to have you today for a very special podcast on one of my favorite topics, which focuses on the project portfolio management in our Renewable Energy and Sustainable Technologies division. Before we get started, a couple of quick notes. These products may be packaged as securities, which are subject to risks, including the potential loss of any principal invested. Past performance is no guarantee of future returns. Investors should always carefully review the prospectus before investing, and securities are offered through Orchard Securities, LLC, member FINRA SIPC. With me today is one of the experts in renewable energy project portfolio management, Jeff Wand. Jeff, we're excited to have you here today. You've been in industry for many years and before you joined Foss. And this is a great topic for us to cover because I think it's an underappreciated topic. So before we dive in, I want to give you a chance to make some comments on your background, talk a little bit about how you got into the space, and then we'll jump into kind of what this topic means, why it's important, what it applies to. So, Jeff, why don't I hand it over to you to give us a quick background on yourself, and then we'll go from there.
Yeah. Hey, Kevin. Great to be here with you today. Thanks for the opportunity to sit down and talk about portfolio management. I've worked in the power generation space for over 20 years. I started off in conventional power, gas-fired power plants, and got exposed to some more renewable technologies like geothermal and hydro, small hydro projects, and thermal solar as well. And about halfway into my career, that's when wind energy and solar PV, solar energy started really taking off. And I moved into the wind and solar space about 10 years ago and have been doing that ever since. And I joined Foss, the portfolio management team here about 2 years ago.
Well, Jeff, it's great to have that background here for our conversation today. And I'm looking forward to your thoughts on, why this topic is so important. But I'll just maybe to frame this up from where I sit, I spend a lot of time talking to investors that are bringing tens, if not hundreds of millions of dollars to these projects. We spend a lot of time thinking up front about due diligence, the return profile of the investment. But I'm not sure every investor spends a lot of time, at least initially, thinking about what happens once the transaction closes. And so that's actually pretty significant. And particularly if you're invested in a tax equity structure where you have ownership of the asset for a period of time and you're exposed to that 5-year compliance window on an ITC deal, for example, that's significant. And I think it's really key that we start by recognizing the importance of project portfolio management for clean energy. So in your view, what exactly is this? How would you define project portfolio management within the context of renewable energy development?
Yeah, it's a great question. I think a lot of people have the same question. They're not quite sure what portfolio management is. It can mean a lot of things. I look at it this way. Everything that happens after final funding is essentially portfolio management. So once the project is not only closed, but fully funded, let's say at least to the substantial completion, major funding. I mean, sometimes we'll take over a little bit earlier than the final funding. But essentially, once the project is, pretty much fully funded, portfolio management steps in and becomes essentially the performance, the project performance or the fund performance manager at that point. And that involves and includes a lot of different things. It's partnership management because, a tax equity partnership is a complex entity and it needs to have managers on all sides. And so we are the partnership manager. It's also financial management, everything, all the financial performance of the project or the fund is essentially overseen by portfolio management. It is also operational in many respects because we're constantly sort of supervising and overseeing the operational performance of the asset or the group of assets. It is tax oversight. It is sponsor compliance oversight. And that's a big piece of what we do is we're ensuring that the managing member / sponsor in the partnership is adhering to all of the contracts that were agreed to when the deal was closed, and that they are complying with those contracts, and not only complying with those contracts, that they're also complying with external, regulatory requirements. So portfolio management is all of those things. But if you had to say it, in a few words, it's really fund performance or project performance management at the end of the day.
Sure. No, that's really helpful because I think it's easy to sort of imagine when you think project portfolio management, it's easy to imagine a portfolio of these generating assets. Maybe it's a collection of solar projects that roll up to this investment. And you think, okay, well, we want to make sure that it's generating electricity, that the electricity is being sold, it's generating cash to the investor. Maybe it's easy to kind of imagine, okay, we're staying in compliance with the regulatory requirements to avoid recapture. That's obviously one of the things that every investor wants to know is, how are we going to avoid recapture of the tax credits? But you make a good point. It goes beyond that too. It's management of the partners, whether that's sort of the literal, partnership and the rules that govern that partnership that's owning this investment, or whether it's the partners in the deal, whether it's the sponsor or project developer, whoever is owning that asset once the investment's closed, that, they need to be looking out for the investor's best interests, and we have to hold them accountable to that. So I think if I'm understanding you correctly, this is a pretty multifaceted role that you take on once the funding is complete. Would you agree?
Definitely would agree with that. Every day when I open my inbox, it's a different issue. It's a different part, a different piece of the puzzle that I'm having to solve. So it's definitely a very varied function.
Sure. Could you share some of that? I'd be interested to hear an example or maybe something you had to work through recently on a project or a group of projects, navigating some of that complexity. Do you have any kind of real world examples you could talk us through?
Absolutely. Yeah. I mean, everybody thinks at first, of course, like as you mentioned, the recapture period is the main concern for Class A tax investors. But also, I think, cash can be a very significant portion of the overall return. And, it's the portfolio management team that's responsible for making sure that cash is flowing out of the project or group of projects and back to the Class A investor. So typically what you see is the partnership will have quarterly cadence on partnership distributions, both the Class A and Class B. And a lot of what we do on the cash management side is we are looking at how that cash is flowing through the partnership and what that cash waterfall looks like at the end of the quarter, and where certain expenses are being paid in that waterfall, where the debt, if there's debt, being paid and when is that being paid and when the Class A priority return occurs in that waterfall and when ultimately Class B's and Class A's return of capital occurs, and where all those things occur in that waterfall is something that we're, diving into on a quarterly basis. And when project structures get pretty complex, like with a tax equity partnership, or even more so with an inverted lease, we've seen quite a few of those lately. Those waterfalls, those cash waterfalls can look pretty complex and pretty mind-numbing in a lot of ways. And we are responsible for making sure that those waterfalls are occurring according to the operating agreement of the partnership, and that, debt is being paid when it's supposed to be paid, and the preferred return is being paid when it's supposed to be paid, and the operating reserves are being funded or drawn on when they're supposed to be, and managing all of that on a quarterly basis. So we're doing that for all of our funds, all of our assets, and it's a big part of the portfolio management job.
Sure. No, absolutely. We want to make sure that the cash is there when it's supposed to be there and it's not getting caught up, right, in some other circumstance that may have come up that wasn't really predictable, or maybe there's misunderstanding around who gets priority to cash waterfall. But regardless, having somebody there to oversee that is key. And just for the listeners that may still be learning some of the lingo, can you just describe for us what the difference is between Class A and Class B?
Sure. So Class A would typically be your tax investor and would typically earn some sort of preferred return in the cash waterfall and would receive a majority, often 99%, of the tax benefits from the fund. And Class B would typically be your sponsor, your managing member, who's managing the asset, managing the partnership, and is what's considered a cash investor, a developer in many cases, but not all cases. So yeah, your Class B is typically your cash investor, and Class A is typically your tax investor.
Great. That's helpful. Thanks. I think that, one of the things that we run into in our world is this belief that maybe project portfolio management is just administrative overhead or it's a passive role. Can you talk a little bit about how the example you just gave and other work that you perform actually ties back to risk mitigation or, performance management? And you touched earlier on ensuring sponsor compliance, how that fits into this picture. I'd be curious to go a little deeper on what the work is that you do and then how that creates value for the Class A and the tax investor that essentially representing through this work.
I would say for a fund that is performing quite well, I would agree that the role is very administrative in a lot of ways. The fund is performing, the sponsor is complying with the agreements, the cash is flowing according to the original, pro forma that was, agreed to when the project was closed. In those cases, it is a very administrative role. Essentially, everything's going well. The tax investor has received their tax benefits that they expected. They're receiving the cash that they expected. The sponsor is operating the project quite well and things are going well. And in that sense, it can be almost 100% administrative in a situation like that. When projects underperform, then a lot more commercial acumen is required to basically understand where things are falling short. Is it the sponsor themselves? Is it just sort of the uncontrollables within the project that are not meeting what the original pro forma called for, or other issues? So in those instances where a project is underperforming, and when I say underperforming, an underperforming project can still be delivering the tax benefits and delivering the cash that was originally envisioned to Class A, but it can be underperforming on a project basis where maybe it's not generating as much revenue as was foreseen, or it has a higher degree of expenses than what was foreseen. And we, even in those cases, we want to understand what's going on. Is it market driven? Is there something that was just missed in the pro forma? And we want to get in and dig into that and understand it, because, those project level problems can down the road, hopefully not, but they can become, investor performance issues if cash isn't flowing in the later years.
That certainly, I think, tells me why project portfolio management is so important, because those seem like issues that, I would imagine most investors do not want to have to deal with on a day-to-day basis. But it's good to know that there's somebody who is dealing with them on a day-to-day basis. Jeff, one other question I want to ask you about the role of project portfolio management as it relates to these transactions has to do with the exit value, or the end of the transaction's life, usually 5 or 6 years out once you get through the ITC compliance period and you're ready to sell the ownership interest back to the developer. When you go to do that, you're trying to capture a pretty important piece of value as it relates to the overall economics of the deal. And of course, things could go wrong. 5 years is a long time. Maybe something happens to the project that has the potential to lower its valuation and therefore the exit value. And the investor doesn't want that to happen. They want to see as much exit value as possible when they go to exit the deal. Can you speak a little bit to the role of project portfolio management in preparing for the project's exit and sale back to the original owner?
Yeah, we're always, as portfolio managers, we're always monitoring when the project will flip, and typically the exit happens pretty soon after the project flips in ownership. So we're always keeping our eye on, and those exits are almost always based on fair market valuations of the project. So we're always keeping our eye on, as things are happening, is that impacting the overall fair market valuation and potentially impacting the investor's exit. So we're always monitoring that, and if things, as you mentioned, things can happen that can have a negative impact on that valuation. And if there's things that we can do, and there are, oftentimes we can renegotiate the post-flip pref for the investor and shore up those exits. We will do that. So we're always monitoring those fair market valuations, and we're always looking for ways for that exit to be able to hit the minimum buyout target that was determined at close.
Jeff, one of the questions that crops up with our transfer credit buyers is whether project portfolio management is relevant to them. They are not an equity owner of the project asset like you would find on a tax equity deal. However, they are still subject to the same compliance period on an ITC deal or project performance fluctuations in a PTC deal. And so I'm curious how you think about project portfolio management in a transfer credit scenario.
Yeah, it's a good question. I will say that project portfolio management on a transfer deal is going to be quite a bit more limited than it would be on a typical tax equity deal. We'd be doing things like delivering financial statements and tracking compliance on certain issues that are typically called out in the operating agreement. One of those would be PWA compliance on the tax credits and making sure the project is complying with that ongoing PWA requirement. And there might be other compliance items as well. And just overall, we really are overseeing the project, making sure there's no major operational issues, major financial issues that might impact the investor at the end of the day. But it is quite a bit more limited than what you would see on a tax equity deal.
Yeah, no, that makes sense. The limitation, of course, is you don't have the same kind of control, but at least knowing that there's somebody keeping an eye on the project, I think can bring a lot of comfort to a tax investor who really isn't spending their day to day, and trying to anticipate what's going to happen to these projects. One of the things that we deal with a lot is this concept of tax insurance. And we see whether it's a transfer credit buyer or in some cases in our tax equity deals, we see these insurance products being added to help mitigate some of the risks involved in these transactions. I'd say in the transfer credit world, it's very prevalent. How does the concept of having an insurance backstop tie in with your work? And what are some of the things, even conceptually, that investors want to keep in mind about the value of having strong portfolio management to complement or maybe support a situation where tax insurance is also in place? Can you speak a little bit to that?
Yeah, I think tax credit insurance obviously is going to give the investor a lot more surety around, recapture on the tax credit, obviously. So it's an extra layer of protection and a very important layer of protection. That being said, it's not the only thing. It's not as if you want to have tax credit insurance and just kind of like, you can kind of forget about the investment and everything's all good. I mean, there are other aspects of the project or the fund performance-wise that need to be continually managed and monitored. And in the case of where tax credit insurance, if there was a claim on the insurance, that would be the portfolio manager being in a position and in a good position to be able to handle that claim. And I think you would want somebody who understands well not only the tax side, but also the project side of things, understands both of those sides in order to manage that claim. I think that's an important piece of the tax credit insurance is having the right team in place to manage any claim if it comes up.
Yeah, no, certainly. I mean, I think we've heard some stories of claims that have been made in situations that may seem very clear cut, but the amount of work it takes to review the facts and circumstances, interpret those, and correctly apply the contours of the policy to that specific situation does require an expert's touch. And I think just leaving that up to the investor, 2 or 3 or 4 years into the deal may create a burden that they don't necessarily want to deal with. And so what I hear you saying is that's kind of a prime role where portfolio managers, the expert that is very used to reviewing these assets and how they're performing and operating, could step in and provide support with that exercise. Is that right?
Exactly.
Yeah. With that in mind, and kind of continuing on this theme of keeping ourselves in the shoes of a tax investor, institutional investor, are there certain things that a strong project portfolio management function can add to an investment that can't be achieved with capital alone, possibly relating to the fiduciary standards that we have at Foss, the long-term sustainability goals of the tax investor, or other things that could help these investments perform to meet the target or modeled outcomes?
Yeah, I would say that, these are complex deals. And when you have a complex deal, I think there always needs to be somebody managing that deal. And I think the portfolio manager is that person. If an investor has sustainability goals, that would be an additional kind of add-on that the portfolio manager would ensure that, that project or that fund is meeting the requirements of those sustainability goals. And I think you would want to have a person watching that and understanding that if it came up, if those goals were coming up short, you would want somebody to be able to manage through that situation. I think on tax equity deals, to not have commercial management and administrative management would probably be not a very good outcome at the end of the day. I think you always want somebody to be watching the investment and managing the partnership probably more than anything, because sometimes you're in a partnership and there can be diverging interests between different parties. And I think you always want to have somebody that is representing the interest of in this case, the Class A investor.
Yeah, and Jeff, what about the technical side of things? I mean, these are, not perfect pieces of machinery that just work as they should every single day. Do you ever get involved in scenarios where maybe there's a underperformance due to malfunctioning equipment, or maybe there's something related to the way in which the project's delivering energy to the grid? I mean, I could go down the list, but you can imagine what I'm talking about. I got to think that there are scenarios you run into where, through no fault of the project developer, maybe the project's not performing. Is the technical aspect something you run into in your role?
Every single day. It's a very, very common issue on these projects. One issue could be that the way that the construction contractor installed the equipment was in some way done the wrong way or faulty, or the equipment itself could have serial defects, and we see that quite a bit. So these issues are constantly, whether it's an installation issue or just a pure equipment issue, or even an operator issue where the operator is not operating the equipment and maintaining the equipment properly. It could be any and all of those, and we are seeing those issues every day, working through them, working with the sponsor to create corrective action plans and implement those plans and get the assets, operating the way they should be. And so we're constantly working with the sponsors and the operators to do that.
Yeah, no, that makes sense. And because you bring up the sponsors and the operators, why should they care about your role? Are you just there to give them a hard time, or do you find yourself developing sort of an operating collaboration with those groups? What's the dynamic like when you're working with project developers or project sponsors?
It's a good question. And I think this makes Foss a little bit unique here, is that our renewables portfolio management team has a lot of experience. I mean, decades of experience in renewables. And oftentimes we find ourselves in situations where the sponsor's manager, whoever's managing whatever that particular function or issue is not doing it up to, let's say, industry standards. And we're very aware of what those industry standards are because we've worked in this industry for decades and we've kind of seen it all. So oftentimes we find ourselves in a position where we are essentially teaching the sponsors, managers, essentially what they need to be doing, or informing them on what they should be doing in a particular case, and not in a way that, we're better than you and, we know what we're doing and you don't. We never really take that approach. It's always collaborative, but we do know how these projects and how these assets need to be managed and operated, and we're familiar with that and what the industry standards are, and we're often working with our sponsors to make sure they're doing that.
That's great to hear. And I can imagine that when done correctly, it's a win-win. These are projects that are ultimately going back to those sponsors. They don't stay with the investor forever, right? And so, if they can come back in maybe better shape than when we first took them on, that is something that benefits all parties. Along that line of thinking, there's a lot of change in the industry right now. We see, technological change constantly. We see a lot of market change, whether that's regulatory or market dynamics, pricing, power prices, things like that. And of course, the elephant in the room is we've got the tax legislation that was just passed in Washington, D.C. here in July of 2025 that's going to have an impact on the industry one way or the other. Is there anything in your mind, Jeff, that project portfolio managers have to keep an eye on going forward over the next several years that you think could really impact this space and is going to be especially relevant to your role?
Absolutely. I would say everything. we we have to keep our eye on everything. I mean, if the market is changing, we need to know what those changes are and what that looks like. If the regulatory environment is changing, we need to know what that looks like. If projects structures are changing, and they always are, and they always seem to be getting more complex and not less complex, we need to be familiar with those structures. If technologies are transitioning and changing, we always need to be familiar with what those technological changes are, whether it's just an advancing existing technology or absolutely whole new technology. Like battery energy storage systems over the last 2 years has been, the new technology. If as a portfolio manager, I was not familiar with that technology, I would be completely unable to do my job. So it's very important for us as portfolio managers to be very familiar with what those new technologies are, how they operate, what the dynamics are. And it really is always changing. So we kind of touch every aspect of the project. And so we have to be familiar with what those changes are, whether they're external or internal or technological.
Well, I'll have to have you back on maybe in a year or two. My favorite word of the day is FIAC, or this concept of a foreign entity of concern that's been introduced in the latest tax legislation that has the potential, in my view, to be something that project portfolio managers are going to really have to keep an eye on in order to avoid penalties to the investor, to the project. That's, relatively new concept at this point. In fact, I don't even think we really know what it means yet from an operational standpoint, but we'll have to figure that out pretty soon. And Jeff, we'll have to have you back on to talk about how you're handling that issue in a couple of years when it really starts to come to the forefront of how projects get constructed and managed through their lifespan. In order to kind of wrap up here, this has been a great conversation and I've learned a lot myself, but I'm really interested in your final thoughts, particularly for institutional investors, developers too, of course, when they're thinking about these tax equity investments or maybe even a transfer credit deal. What's something that you think they should keep in mind when it comes to project portfolio management and the role that can play in their experience working in these deals?
Yeah, I mean, from the investor perspective, of course, you want the best team to be there managing, the fund. And I feel that we are a team that does that very well. And we have a lot of interaction with our investors, and we enjoy that interaction very much. And we enjoy when our investors feel comfortable and confident and assured that these funds are going to perform to what the original expectation was. So that's really ultimately at the end of the day what it's about. And when investors are happy, I'm happy. So we just look forward to doing more deals and having a larger portfolio and delivering on performance at the end of the day. That's really what it's about.
Thanks, Jeff. Couldn't put it better myself. That wraps up today's episode on project portfolio management and renewable energy and sustainable technologies. Thanks for joining us. Please be sure to subscribe and tune in for our next episode. And to learn more about Foss's approach to project execution, long-term asset performance, please connect with our team or visit our latest insights at www.fossandco.com. Thanks.